Hi everybody, welcome to Talking Automotive with Mark and John. My name is John Sinclair and my co-host Mark Palavestra.
Hi John, today we've got the Managing Director of Glasses Information Services Australia, Santo Amodio. Santo covers off how his organisation predicts future values and all the elements that come into the depreciation from short cycling through to advertising, discounting and pre-reporting demonstrator pushes. He also covers off some very topical information around his experience with electric cars in Europe and the surprising low level of depreciation with EVs.
Yeah, Mark, he also jumps in, delves into the future of automotive and talks about the major trends, everything around electric vehicles, autonomous cars. A really good listen. So let's jump into it.
With 30 years' experience in auto logistics and state-of-the-art locations in 5 major Australian cities, Precar Fleet Services is an independent division of Precar Services, offering specialty fleet fit-outs for commercial applications ranging from simple tray and tow bar fitments to fully bespoke service body and accessory installation. With quality-assured safety, compliance and standardisation of vehicle builds, Precar Fleet Services are a premier all-in-one solutions provider for commercial vehicle fleet operators, leasing companies, and original equipment manufacturers. For further information on how Precar Fleet Services can assist in solving your commercial vehicle fit-out needs, please visit precar.com.au and click on the link to Fleet Services.
Santo, thanks very much for joining us today. It's great to have you on the show. Maybe just to start off, can you tell us a bit about AutoVista and Eurotax Glasses? Can you just tell us a bit about the company and what sort of thing you do?
Glasses Information Services Australia is part of the AutoVista group of companies. AutoVista is predominantly based in throughout Europe and the UK. What we do is we provide, what we're well known for is our vehicle specification and valuation services. So we provide a range of valuation services in Australia for passenger vehicles, light commercial vehicles, motorcycles, boats and caravans. And we provide these services to fleet finance, leasing, insurance companies, car companies, classified websites and car dealers. Across the AutoVista group, they also provide service, maintenance and repair data across Europe and the UK. This is supplied predominantly to insurance companies and repairers. We can help you with collision estimating repair and also, service and maintenance information as well. There are about 800 employees across the group. Glasses in Australia has been in business for more than 65 years and in the UK since 1933. We have several brand names across the group. We're well known in Australia as Glasses. In the UK, we're also known as Glasses. In Germany, our brand name is Schwacke, and Eurotax Glasses is the brand name in a couple of countries in Europe. And AutoVista is also a brand name that we use across Europe.
And so, Santo, you mentioned the services that you provide. So I'm keen to do a bit more of a deep dive because that's a pretty broad range of information that you share. So in the instance of specifications for valuation, is that for just residuals for used car values or what other purposes is it used for?
I'll start with the vehicle identification and specification. So we have a catalogue of data which accurately identifies a vehicle down to its variant, body style, engine size, transmission type. So we can uniquely identify a vehicle. What we do is we start with a new vehicle release and we'll enter that new vehicle into our database, including year, make, model, fuel type, and we'll capture a whole range of specification information which will help us identify the vehicle, including all of the standard specs that the vehicle comes with, as well as optional extras and options pricing. So we start our process with a new vehicle. We start to track that vehicle as it becomes a used vehicle. The range of services we provide in terms of pricing is current market value. We'll have a retail value, so that's what we call our franchise dealer asking price. We'll have a trade value, so typically what would a franchise dealer pay for this vehicle to bring into his inventory, and also a wholesale value, which is typically what you would get for this vehicle at auction. On new vehicles, we also provide forecast, and we forecast residuals out to 5 years based on time and distance bands, and we provide forecast services mainly to the fleet and finance sector.
So how do you make that crystal ball to be as clear as possible? Because that would be the golden goose, if you like, for predicting what this car is going to be worth in 5 years' time. And how accurate is that?
Forecasting residual values is really, really tricky, and it's really difficult. When customers ask me how accurate are Glass's forecasts, my standard response is, if everything stays the same, we're accurate. In the event of some sort of disruptive event in the used car market or in the economy, for example, we had the GFC in 2008, 2009, and that had an impact on forecast residual values. Dieselgate had an impact on residual values to a lesser extent in Australia, but more throughout Europe. More recently, the COVID situation that had an impact on forecast residual values. So if I produce a forecast valuation today for a vehicle, looking at that vehicle and predicting what its value is going to be in 3 years' time, based on time and distance bands, and that forecast will be based on knowing what we know today and knowing what's happened in the past, and we take a view on the future. However, if the share market crashes and drops 30%, then the forecast that I've produced today is worthless, because that's going to completely impact that forecast.
So what sort of ingredients do you look at? What are the inputs for that future value prediction? Because I've used your future value predictions in a number of organisations, and I've got to say they've been exceptionally good. And the benchmarking to project what a product that you're launching or have brought into the market it's been spot on. So what are the elements that make up or go into that melting pot of predicting that future value?
The one that provides us with a great deal of comfort is history, because history tends to repeat. Not so much today. And to give you an example, a 3-year-old Corolla would have a very similar residual value to what a Toyota Corolla 10 years ago that was 3 years of age had in percentage terms. What we look at when we're forecasting residual values is we start with the new vehicle. We look at how it compares in the market to other vehicles in the same segment. We look at how it's priced against those competing products, to what level it has in terms of its standard spec to competing products. We look at the sales mix between how many of these vehicles are going into fleets, rental fleets, leasing companies, and how many are going into private buyers' hands. Because we know that the vehicles that are bought privately tend to stay in ownership for longer periods of life. So we look at how many short cycle vehicles a car company puts onto their fleet. And these are typically executive cars, and how quickly they turn those over, because they're typically the first vehicles that come onto the used vehicle market. But the ownership profile of rental fleets has changed significantly over the last 10 years. Typically, 10 years ago, rental fleets would hold cars for 6 to 12 months. Today, they'll hold cars for 2 years. We look at the car company's pricing policy, level of discounting, what sort of marketing campaigns they're running on the vehicle, whether those marketing campaigns are value add or whether they're discounting the price. So in our view, the biggest impact on residual values is what the car company does when they launch the vehicle, when they remarket their first batch of executive-driven vehicles. That they typically have the biggest impact on residual values. The private new car buyer, they will buy the vehicle at new, and by the time they come to sell that vehicle 3, 4, 5 years down the track, there's a lot of stuff that's happened with the car company bringing back company vehicles, with demo models, with short-term rentals. What's happened in those first 2 years of the vehicle's life cycle has been impacted by car company action. So by the time the private buyer goes to trade in their vehicle or sell their vehicle 4 or 5 years after they've bought it, there's not much that they can really do to influence the residual value, because things that have happened earlier in the life cycle have been impacted by the car companies.
So with the depreciation curve, is it fair to say, and I've seen you've used your data quite extensively, is that first year is around about a 30% depreciation, and then it sort of drops down to 15 and then 10, and then it sort of flattens out. The curve is steep to start with, and it sort of flattens out?
Yeah, that is correct. So we typically see, or historically I should say, we see most depreciation occurring in the first year of the car's life. So up until a few months ago, because the world's changed significantly, when you bought a new car, as soon as you left the lot, it had dropped 10, 20% in value. With COVID, vehicle values, for the first time that I can remember across the board, used car prices are increasing and have increased significantly over the last 6 months.
Do you think that's going to maintain that? I know it's now through COVID, or do you think it will go back to that normal curve once the supply comes back in?
I'd like to go back to, say, 18 months ago. If you look at the Australian new car market back then, the new car market was in decline and had been in decline for about 18 months. And new vehicle sales were down about 20% from their previous highs. At the same time, we had the Banking Royal Commission, which made it really difficult for people to finance new and used cars. There were a lot of restrictions placed on finance companies. Prior to the Banking Royal Commission, finance a vehicle, it would have been done on the spot. More complex processes were put in place and approvals were put in place, and it could take up to 2, 3, 4 weeks to get a finance approval. And the Australian new and used car market at that point in time was also very highly competitive. Most brands were promoting discounted offers on new and also demo cars. Demo cars were a significant feature of our market. So we were in oversupply for both new and used cars. And at the time, franchise dealer profitability was around 1% net return on sales. During COVID, and car companies stopped or reduced their production. As a flow-on effect, component manufacturers did the same. They also stopped and reduced their production. And one of the things that really impacted the market and continues to impact the market or production at the moment is that semiconductor manufacturers, and they switched to supplying the semiconductors to mobile phones, computers and other electronic goods. Car retailers, and what they did was they either completely disposed of or removed a lot of their used car inventory from their lots. So they just sent everything out to wholesalers or to auctions. With travel stopping, car rental companies who rely heavily on business travel and tourism, they saw their rental activity volumes fall by 80%. And they also took action to defleet most of the cars. Looking overseas and using the UK market as an example, in lockdown, in April last year, new car sales in the UK declined 97%. Our new car sales volumes fell by almost 50% in April last year and 35% the following month. So, and this is against a backdrop and a pattern of declining new car sales volumes anyway. At the same time, car companies and dealer orders for new inventory essentially just came to a grinding halt. The federal government, they introduced some stimulus packages, including JobKeeper and JobSeeker. They allowed people to get access to superannuation. We saw interest rates fall to historically low levels. This created an environment where consumers had access to very cheap money. They had surety with JobKeeper and JobSeeker payments, as well as they could access their superannuation to fund new and used car purchases. Look, at the same time, we couldn't travel. Consumers were using money that they could get their hands on to buy or to fund car purchases. Mid to late 2020, we saw new and used car buying activity increase. And a lot of dealers were caught red-handed because, one, they'd taken action to reduce their inventory quite significantly, and car companies, hadn't really ramped up their production levels back to pre-COVID levels. And people who typically caught public transport to work and were not willing to catch public transport, and so they were going out looking for a second vehicle. That created additional demand. Car companies recommenced production, but they were unable to ramp up to pre-COVID levels as they were forced to implement social distancing within their production plants. So whilst their production plants were operating, they weren't really able to produce as many cars as they had pre-COVID levels. with Australia now being a 100% import market for new cars, we're probably the furthest market away from the production plants around Europe. Car companies who are building cars for our market, they diverted production to markets that were closer to their production plants. So we were left in short supply in terms of new vehicles. We've seen some incredible increases in prices, particularly across sports utility vehicle segment. There's a few reasons for that. Inability to travel overseas, has created demand for touring holidays and caravanning. Caravan sales have also boomed. Fortunately for us, that segment is well catered for by local manufacturers. Iron ore prices rose significantly, and that created demand for light commercial vehicles, particularly in mining states of Western Australia and Queensland. With reduced car production capacity, lead time on some new models has increased, to 6-9 months, and that's created demand for near new cars as well. In April, we had record new vehicle sales. We had over 90,000 new vehicles sold in April, which was an all-time high for April. Many experts believe that these are vehicles ordered in the last quarter last year, which finally arrived on our shores during the month of April. In the next few months, strong new car sales will continue. There'll be continued pressure on used car prices.
We share your views on all of that. We put a prediction out earlier this year that this year was going to be a 1.1 million car market on the back of the 912,000 cars sold last year. And we had people say to us that we were mad, that how could it ever go from just over 900 to over 1.1? It's well and truly on track to exceed that 1.1. Can you see that pain returning once the initial supply has caught up with the 1 million orders that normally take place?
We'll see shortages of supply for the near term. So for the next 3 to 6 months, it'll take quite a while for car companies to catch up. So we'll still see strong demand for new cars and used cars. Look, from a historical perspective, used car values have always fallen. As I mentioned earlier, they fall heaviest in the first 3 years of their life. So we have some concerns about prices that are being paid for cars now, and that these prices will be unsustainable going forward once the market returns to some sort of level of normality. So we've got consumers paying 20 or 30% more than what their historical values are. We've seen examples of, and this is probably a unique situation where Toyota is rumoured to be discontinuing the V8 variant of the Land Cruiser. So there's a mad scramble in the market to get your hands on a V8 Land Cruiser.
That is incredible. It's a bit like, what are you seeing with the last of the Holden V8s, where we're seeing some crazy prices for some of these already collector cars, and yet they're still very new. What have you seen with those vehicles?
Holden's a unique situation in that brand no longer exists in this market. So there is some scarcity value. Holden's been out of the market now for a couple of years. And I think if you're looking at which of those vehicles are going to appreciate in value over time, it'll be the more niche models, the high end with large V8 engines, the large Monaros, the large HSVs that were produced in limited numbers. Typically, they're the vehicles going to increase in value and continue to increase in value over time. If you own a stock standard Commodore base model, unless it's unique in some way, in that, for example, it's got very, very low kilometres, then we think over time that they'll depreciate and lose their value. But again, it's a scarcity. When something becomes scarce, it increases in value and creates interest in the market for that product.
You mentioned the repair costs and the service costs. Can you go into a little bit more detail about how you determine those figures?
We rely on OEM data, so we get our data from car companies. So these are the service intervals information, what's required during the service, and what parts and components to use during that service. So this is used by workshops, and with the collision repair estimating software, that's used by insurance companies and panel shops. Again, we use car company data, so we get the repair times, the repair methods, paint times as well, parts, catalogue, and parts pricing, but we create our own 3D diagrams of the vehicle. And for example, if you have a collision and the front right-hand side of the vehicle is damaged, you would click on a 3D image of that vehicle at the right-hand side, and all the components that are in that part of the vehicle would explode out into a line diagram, and you could select the parts that needed replacement, and it would then tell you how to dismantle and reassemble and tell you how much time it would take.
What trends are you seeing in the industry? Because right now we're a bit of at an interesting nexus, because for quite a long period of time, internal combustion engines were all the go. We sort of played around with there was a diesel phase through the early 2000s and probably into the early teens. Low displacement petrol turbos have sort of taken over a lot of the mainstream four-cylinder market. EVs are here, but very low volumes. There's talk of autonomous vehicles. Where do you see the auto industry going?
There's 5 megatrends that we're dealing with at the moment. One is autonomous vehicles. We split that into 2. So there's advanced driver assistance systems. One of the early advanced driver assistance systems was power steering. Autonomy has been going on for decades. There was a lot of talk a few years ago around autonomy, but particularly around self-driving features and self-driving vehicles. Interestingly, that talk has basically come to a halt. We're not seeing much of that at the moment. Car companies are focusing more on advanced driver assistance systems, emergency braking, lane distance control, lane departure warning, those sorts of things. Another industry or automotive industry mega trend is connectivity. And car companies now and consumers and fleets are requiring a lot more connectivity between themselves and their vehicle, and electronic equipment that they have outside their vehicle. They want it to be able to connect with their vehicle, and they want their vehicle to be connected with other devices as well. Apple CarPlay seems to be doing a really good job. Third mega trend is digitization of sales. And we've seen that evolve over the last 10 years, but COVID has given it a second wind. And we're going to see a lot more of that digitisation of new and used vehicle sales. People will shop from home or shop on their phones. We'll see less of dealers operating on forecourts. The fourth automotive industry megatrend is shared vehicles. And again, this was a very fast-growing segment of the market pre-COVID, but COVID put the brakes on vehicle sharing, and it was quite challenging because these vehicles they need to be cleaned after each use now, and we saw companies start with subscription models. You've got Lynk & Co, which is a pure subscription-based car company, but that's not a shared vehicle. But we're seeing some challenges in the shared vehicle space. The biggest automotive industry megatrend is electrification and regulation around electrification. We're seeing lots of investment. Car companies are investing heavily in electric vehicles. We're seeing many car companies born out of China that are purely building electric vehicles. What we're seeing now is that almost 1 in 5 new vehicle releases in Europe is a new electric vehicle OEM. Didn't exist in the market 3 years ago. Unfortunately for our market, our government has not pushed the sale of electric vehicles or made it easier for consumers to get into electric vehicles. If we look throughout Europe, in some markets, electric vehicles account for 50% of all new car sales. Norway, more than 50% of all new car sales now are electric cars because of government rebates that are available to consumers.
And Santo, how are the RVs holding up on those electric cars? Because originally, when EVs were launched 10 years ago, there was this massive panic, even with the Prius. Oh my God, it's got a battery, it's going to cost me a fortune, the car's going to depreciate to nothing. When I look at some data, it doesn't seem to be the case. Is that correct?
We're not seeing a lot of EVs coming back on the second-hand car market at the moment. There's not a lot of data, particularly in our market. EVs account for less than 1% of new vehicle sales. They're a very, very small portion of the market. But it's interesting what you said about, people worrying about battery life. What we're finding in some markets in Europe is that the battery now outlives the car.
Because that was the panic. That was the big panic. It was like, oh my God, 3 years, it's done. So the batteries are still going.
In most of Europe, EVs account for between 10 and 20% of all new car sales. And that's largely because of incentives that the government has put in place. At the same time, governments have said that, they'll only allow EVs into certain parts of cities. They'll offer concessions for EVs. Whereas here in Australia, some state governments are talking about taxing EVs based on the number of kilometres that they travel.
That's incredible, isn't it?
So there's a further disincentive to buy an EV. And this is not only on new EVs, but also on existing EVs out there.
So the EV residuals in Europe, 10 years now of reasonable volumes, are they holding up in a similar percentage to what the internal combustion equivalents would be?
They are comparable now. But interestingly, as EV sales increase and ICE engine sales fall, there's a scarcity of ICE vehicles on the used car market, which is pushing prices up and will continue to push prices up because second-hand car buyers still favour internal combustion engines.
But EVs don't have the horrific predicted depreciation that the industry were expecting, where the fear of this expensive battery would write down the value of the car.
It doesn't seem to be the case at this point in time. And look, EVs are still in their infancy in terms of their life. And over time, we expect that, a few things will happen. Battery life will improve. Charging times will reduce. The weight of the battery, which is a significant issue, will also reduce. Drivers will get more range and require less time to recharge their batteries.
You went through quite a range of product options you offer. Can you maybe tell us how would you summarize the problems you solve with your products?
So look, we provide information throughout the life cycle of a vehicle. We help our customers understand what vehicles are in the market, starting with new vehicles, what features they have, what their pricing is. Once they become second-hand cars, what their market value is, and also what their future value is. And in the event that they need to be serviced, maintained or repaired after a collision, we can provide our customers with information to help them navigate through those processes as well.
Where do you see the future of mobility?
We're seeing more and more people move into inner city living. So there's going to be probably going forward, there's going to be less demand for car ownership and more demand for car usage. And typically, younger generations, they're used to renting. They rent their phones, they rent where they live. So renting a vehicle for a day, an hour, a week, a month, quite normal to them. Shared mobility was going to solve that, but with COVID, we're seeing some resistance there. We're going to see greater uptake of electrification of electric vehicles, and particularly once car companies get some economies of scale in production, because there's a significant price disparity still between an internal combustion engine and an electric vehicle. But once that price gap reduces, we're going to see a faster uptake of electric vehicles. The infrastructure issue for electric vehicles needs to be addressed in our market. There's simply not enough charging points around, and governments are leaving that to private industry, but private industry wants government support. So we see that as an ongoing issue. And look, I think we're going to see some further advances in vehicle autonomy, but I don't think we're going to get to a level anytime soon where we'll have completely self-driving vehicles.
The self-driving dream that we thought was going to be the case is not going to happen anytime soon, not before 2030.
I don't think so. And look, there's a lot of things to happen first. I mean, you've got regulation about, does a driver need to be in control of the vehicle? Are our roads and traffic systems ready for self-driving vehicles? And is the technology good enough or reliable enough to rely on? And at this stage, it's not. the focus will be more on advanced driver assistance systems. There'll be more development in those areas rather than vehicle autonomy.
Imagine being on the corner of a city intersection and having competing drivers and driverless cars driving through that intersection. And then if there's a collision, who blames whom? So does the driver have to adapt to in case the autonomous car has a malfunction? And how do you prove it? And just that whole the coexistence of when we actually will have, and I'm sure it will come someday, where there'll be autonomous cars and there'll still be the enthusiast driving cars.
I still believe somebody will need to be in control of the vehicle. And it's interesting, who's at fault. And we could have car A with one software platform and car B with a different software platform that, reads traffic slightly different to the other and interacts with traffic differently. So there could be issues created around, different technologies. We still have internet issues, buffering. What happens if you're going through an intersection and, the technology you're using other traffic around and it doesn't have enough bandwidth to cope with what's going on?
Once you overcome that, it'll be quite interesting because then you'll get us to this level where you don't need traffic lights or anything because all the traffic will be coming down and there'll be communication between all the cars and saying, okay, those 5 cars go and these 5 and then that 5. And so I think it'll be quite interesting. It just improve the flow and the way traffic moves because all the traffic will be moving at the same speed.
But there's the fundamental problem. You need 0 driver cars then. And that's where you're going to get this. It's a 30-year overlap between having a mix of some driver and driverless to then potentially none. It'll take 30 years to flush out all the driver cars, just like it'll take 30 years to flush out all the internal combustion cars with EVs. So it's not a quick overnight thing unless you have a dictatorship that mandates all cars get removed and crushed, and then everything is only driverless or everything's only EV.
We have 17 million cars on the road here in Australia that aren't self-driving vehicles. So we would have to get every single one of those vehicles off the road or adapted in some way, if they're able to be adapted, so that they could all be self-driving cars. It would also require, changes to legislation. Or the Traffic Act would have to be rewritten to cope with self-driving vehicles. So, there's a lot of things that need to happen for our market, for any economy to have fully self-driving vehicles on our roads. And we've seen, instances, and they always hit the news where people have put their self-driving vehicles on autopilot and come to grief because of some sort of problem with the technology. The cars that have that technology in them today are not designed for that purpose. They're designed for the driver still to be behind the steering wheel and in control of the vehicle. And that feature is sort of just augments their driving experience rather than completely takes over. Just with electrification, there is a risk and there is a danger that, we could get left behind here in Australia. Car companies reducing the build of internal combustion engines and ramping up electric vehicle production. If we don't have the infrastructure in place, if we don't have the government support in place to get buyers into electric vehicles, then 7-10 years we could be left behind with a shortage of cars in our market. We're at an interesting juncture or interesting point in this market where we need to either jump on board or start producing cars locally again for our purposes.
The other thing that I was keen to also just highlight, and this is where I think our listeners definitely should reach out to you and your organisation, but just your future value, given that a lot of brands are going down this road of guaranteed future values, giving users or even organisations visibility to your future value forecast. And I've mentioned before, I've used them before and I've found them to be terrific. But when you outlined all the elements that your organisation takes into account when you assess and predict the future value of a vehicle, there's historical information, but all those little elements, those 1%ers that have significant impact into the future value of a vehicle, your information and the elements of advertising, demonstrators, short cycling, discounting, all the way from launch and what percent the private buyers are of that particular vehicle, come into play big time when you look at what is this car going to be worth in 3, 5, 7 years' time. So if people haven't already done so, I urge them to visit your site, reach out to you and your organisation, and to seek more detail on that future value product.
Thanks, Mark. Look, it's a process that we've worked on and continue to refine. We've worked on forecasting for decades, and we're always looking to improve it. And it's an interesting time at the moment because we have to reevaluate every vehicle value because of increase in used car prices that's occurring across the market and continues to occur. We're only now starting to see the market sort of come back to some level of normality. The used car market demand is sort of starting to drop off. We don't know whether that's a temporary blip or it's an ongoing trend.
And the stuff on how you work the future values database, most people would have no clue on those elements and how they contribute to where an RV is, and how in a normal market they're the things that come into play. Everyone's a hero right now, whether you're in a car company or whether a used car trader, you're a hero. But you and I know that this is not normal. We are not in the new normal. The new normal will be normal.
We look at this as a disruptive event in the market, but it's having a positive impact on used car values. But as I mentioned earlier, we've had other disruptive events, including the global financial crisis, where vehicle values tumbled. They're heading the other way at the moment, but it's unsustainable.
No, I agree. I'm actually getting nervous, and John and I chat about this a lot. I'm actually thinking this is almost like a dead cat bounce. And you're spot on. I just wrote a paper on the profitability of the dealer network being just on 1% net profit to sales in 2019. 2019 was a really horrible year for this industry. 2020, people think was a bad year, but it actually was a good year. It was actually pressing reset on what was a pretty screwed up industry and screwed up market. And by allowing funds to flush back in again and people to be able to buy vehicles and also clear out the old aged inventory and all the pre-reported stuff meant that the reset was set, but it's now up to the industry to be responsible in what they supply to this market. And what John and I know from the car companies we've been involved with over the journey is they can't help themselves. They just shove stock down. If there's a glimmer of profit here, they're sending cars down here, especially if the other markets are stuffed. They would have looked after them first. Now it's, Australia's charging, prices have gone up. Let's send more stock. Every franchise that will show a positive growth versus last year, it looks like a hero now, but come January next year, the expectation from every global head office will be you must do 10% more on what you did last year. So when this bounces to be a 1.1 million market, and then the head office says you will do 10% more across all the brands, that's 1.2 million cars. I don't think it's a 1.2 million car market next year.
No, and look, we're certainly not out of the woods in terms of COVID. COVID's going to be an ongoing issue. It's not going to go away. There's no cure. We're going to be faced with continuing disruptions in our market. We're going to have more lockdowns, whether we like it or not.
Thank you so much for covering off a lot of what you do and what your organisation does at AutoVista Eurotax Glasses. So your business is over 65 years old, branches here in Australia, and you run the Australian division, but you've got extensive experience across the divisions in Europe. And you share some really good information around the learnings in Europe, which I think apply so much to the Australian market. And a lot of questions that people reach out to us asking, particularly around the EV space and autonomous vehicles. So you mentioned the 5 big trends in the auto industry, the autonomous vehicle. And when you think of autonomous vehicles, we often think of the driverless car. But you rightly point out the autonomous enhancements are ongoing. Power steering, power brakes, cruise control, then it becomes adaptive cruise control, then it becomes adaptive braking, etc. So there are countless innovations that are improving the way drivers drive and making it easier to drive, less fatigue and minimising accidents and making us all safer. But also you talk about the connectivity, which is the Apple CarPlay and the other connectivity that vehicles have where data from the car goes to the OEM or goes to the dealer to update with service issues, or if there's faults with the vehicles, and we see that with Tesla and their incredibly connected vehicles. But a lot of the premium brands and even the mainstream brands are taking on that technology. And then you talked about the digitization of sales, and this is the COVID effect where it's sort of accelerated us to be online and buying vehicles, transacting vehicles, selling vehicles, and we're more comfortable with doing so rather than having to sit in a showroom or on a forecourt to look at a vehicle. And then there's the electrification and the shared vehicles. So the share economy, car share, subscription models, and the like, adding value where you don't actually own the vehicle, you use the vehicle. And then there's the electrification. But the key one for me is your learnings and the value that you and your organisation provide around the questions on residual values in Europe and the trends that you've seen with a large amount of data, significant car park of electric vehicles, all the fears that we had here in this country and globally, but you've got hard data to show that electric cars don't have the horrific depreciation that many people thought they had or thought they would have, because there is still a robust aftermarket for these vehicles. And I think that's a positive sign for governments, EV manufacturers, and potentially some form of incentive to build that car park of used cars to get more used EVs on the road and maintain them on the road, because that's going to actually increase the acceptance or user acceptance of an EV and getting those cars to the masses more so than just the high end where currently the EV market is placed and positioned, where we see Teslas, but they're all expensive vehicles. We're looking at the EVs that are coming in, they're high-end Volvos and Land Rovers, etc. So they're expensive vehicles, expensive EVs. So some really good learnings there. And you talked about the take-up. It's when that price gap between the internal combustion vehicle and the EV is the tipping point where we go from innovators and early adopters to actually the early majority jumping on board. So that's a big thing, and that charging infrastructure and charging time it takes. So going how long it takes before you actually fill up again with your charge versus the convenience of an internal combustion vehicle right now, which is 10 minutes and you're on your way. Whereas with an EV, currently it is not. So those are key elements when we look to the future, and that future potentially is not that far away. So your trends that you've identified are, I think, spot on the money, and your timings are pretty much right too. So have I missed anything?
No, Mark, that's a perfect summary.
Thanks for joining us today. We really enjoyed it.
Thank you, John, and thank you, Mark. It's a pleasure.
Thank you, Santo. Thank you for listening today. Hopefully you enjoyed the conversation with Santo as much as we did. Some great insights into how to predict a future value for a used vehicle in the short and medium term, plus also some very good insights into electric vehicles and the experiences in Europe around residual values. They're not as low or scary as or what we thought they would be. That was a big surprise to me.
Yeah, Mark, it's really interesting. And to me, I was fascinated around the autonomous vehicles and where Santo saw the future of autonomous cars, because I thought it wouldn't come quickly, but some of the concerns he spoke about, I can see it's going to be a lot longer than expected.
Indeed. So if you enjoyed what you heard today or need more information, please reach out to either John Sinclair or myself, Mark Palavestra, on LinkedIn, or leave a message here on YouTube, or reach out to us via our website on Auto Currents. Like us on YouTube, subscribe to our channel, and also subscribe to us on iTunes and Spotify.
We're also now on Patreon, so if you would like to visit us on Patreon, you can also do that. Thank you for listening.